Quilter Cheviot's Markets Uncut podcast, a weekly insight into topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following #QC Weekly Comment on LinkedIn. I'm your host, Andrew Cartwright, investment manager based out of our Birmingham office. And this week, I'm delighted to be joined by regular commentator and head of fixed interest research, Richard Carter, and head of property research, Oli Creasey. Welcome, Richard and Oli. So, Richard, starting somewhat inevitably with the developments over the past week, the situation in Iran feels as though it's now dragging on rather than being resolved quickly. And we're increasingly hearing from clients who are understandably concerned about that. And yet, despite those ongoing risks, equity markets have rebounded very strongly in recent weeks, with US equities pushing on to new all-time highs. Richard, could you give us an update on the events in the Middle East over the course of the past week, and how do you interpret that reaction from equity markets? What do you think it tells us about the time scale that markets are pricing in for the conflict, and do you think investors are right to be relatively relaxed at this stage?
It's a good question, Andy. I mean, it does feel like a little bit of complacency there, but it seems to have all turned into a bit of a sort of frozen conflict, doesn't it? I mean, last week there were supposed to be talks taking place in Islamabad. They haven't really happened, and there does certainly seem to be a real debate going on in Iran between sort of more moderate politicians and some of the hardliners about exactly what their negotiating tactics are going to be. The good news, though, is that the ceasefire was obviously extended by Trump, and he does seem, and this sort of plays back into the kind of investor sentiment, he doesn't seem like he wants to go back and sort of restart the actual fighting or conflict. So it's just sort of turned into this sort of frozen situation where the Straits of Hormuz aren't open, but there's no actual sort of bombing going on. So, I mean, the market reaction in some ways has been a kind of standard playbook with sort of geopolitical events. There's been a big sort of sell-off when it all started happening, but then since then has recovered. And the focus has in some ways moved back to, sort of more bog standard stuff, so like company earnings, sort of economic fundamentals, and actually, latest earnings numbers have been okay. The chip makers, so some of the tech stocks in the US have been on absolute tear, and that's pushed the US market up again. So yes, there's definitely, I think it feels like some complacency. I'm still very worried about the sort of long-term inflation impacts. But the good news, I guess, is that Trump does seem to be hoping for some sort of, agreement through negotiations rather than starting to fight again.
Now, you touched upon inflation, Richard, and of course, the sort of key implication of the events in Iran is the impact on oil prices and ultimately for inflation. And last week, we had a raft of important information data released. In the UK, we saw inflation pick up again with the CPI up to 3.3% for 12 months to March, with petrol prices the key cause. And in the US, headline inflation also rose to a similar figure, 3.3%, up modestly from the month before. And those releases were the first inflation reports to actually capture some of the impact of higher oil prices since the start of the conflict at the end of February, although we're only really starting to see the early stages of that effect rather than the full picture. And with that in mind, this week is going to be very busy with many central banks meeting to make policy decisions, and we're going to see meetings from the Bank of England, European Central Bank, US Federal Reserve, and the Japanese Central Bank. So, Richard, since the conflict started, interest rate expectations have been swinging sort of wildly between cuts and even the possibility of hikes. And with inflation now proving a little stickier, what are your thoughts and expectations going into those meetings? Do you think central banks are likely to lean towards a wait-and-see approach for now, or do you expect any meaningful shift in tone or guidance?
I think we'll definitely see a wait-and-see approach, and it's too early for them to start raising rates or anything like that at this stage. But I think there will be certain warnings, particularly in Europe and the UK, about the impact of the oil price rise, and if this conflict does continue to extend into the summer, I think they'll be warning about the impact on inflation and the possible need for rate hikes. So as I say, I think that's going to be more pronounced in Europe and the UK, where the impact is bigger. I think the Fed will just be in a plain wait and see mode, although it might give some sort of soft warnings on inflation. But I think overall they're in a slightly better place because there should be less of a sort of long-term impact on the US inflation numbers. We'll see. But I mean, they can't just focus on inflation, of course. They've got to think about the growth impact of all this. And we have seen some weakness in the UK in over the last year or so with the economy, but I think the Bank of England's primary focus has got to be on inflation.
Thank you, Richard. So whilst most of the attention over the past week has understandably been on the developments in the Middle East and the implications for inflation and central bank policy, property is one asset class that tends to be particularly sensitive to changes in interest rate expectations. So I'm therefore delighted to welcome back Oli Creasey, our head of property research. And Oli, it's interesting to note that when you last joined a podcast back in June of last year, we were discussing almost the exact same geopolitical backdrop. So with that in mind, Oli, we've seen renewed volatility in inflation and interest rate expectations, which clearly matters for asset classes like property. But at the same time, property valuations don't update very frequently, so that there can often be a lag, whereas listed real estate and REITs tend to react much more quickly. So with that in mind, could you give us an update on what's been happening across the property sector since the start of the year, and how are you seeing that valuation lag versus listed markets dynamics play out so far?
Yeah, good questions. Thanks for having me back, Andrew. One day we'll speak when the property market is in full force once again, but it's not today, I'm afraid. You're absolutely right to highlight a few of those things. 2026 has actually been a bit of a roller coaster for property, but that does depend on how you choose to look at it. If you look at the UK REIT market, it has been that roller coaster. So up in January, February, down in March, and back up again in April. And actually, January, February was a period of comparative quiet and normality in the market, although it feels like a long time ago now, where things were perhaps starting to get a little bit more back to normal. And then clearly the events of March and April so far have reversed course on that. And the impact is, although it's been quite volatile, actually the market itself is more or less flat year to date in terms of REIT share prices. And actually, I'll quote that on total return basis, but it's down about 1% year to date in a total return basis for investors. If you were buying direct property, or if you were at least looking at the indices that track direct property values, you might have had the very similar sort of outcome, but a very different journey to get there, because actually property prices themselves have barely nudged in either direction year to date. They're pretty much exactly flat, and I think that is a reflection of the sort of almost the personalities of those two markets, if you like. The REIT share prices traded on the stock exchange are inherently liable to sort of trade on new information very, very quickly, and the property market itself is perhaps known for being slow to react to new information. And I think that's kind of where we are at this point in time. It is interesting because there is a valuation lag there. We've seen a clear and pretty determined response to geopolitical tensions in REIT shares, and we haven't seen anything at all in property values. How long that lasts is to be confirmed, and is very much dependent on which of the various pathways we take through or out of this conflict in Iran. But it's a lag that does exist, and it can't persist indefinitely.
And as discussed with Richard, interest rate expectations have been shifting around a lot since the end of February, and that's clearly shown in both gilt yields and across the rate curve. And of course, we've got that another central bank decision due this week. So from a property perspective, what happens next? How sensitive are different parts of the sector to changes in rate expectations? And at what point do rates become more of a support rather than a headwind?
Well, yes, exactly. What happens next is, I suppose, the $1 million question. And I suppose it always is in some sense. But I think what is interesting to me, and well, perhaps it's interesting to everyone else and frustrating for me, actually, if I maybe just rephrase that slightly, is that the certainty of outcome measure, how you choose to measure that, is about as low as it's been in sort of, certainly from my perspective, almost living memory. Yes, interest rates are going up, gilt yields have gone up. What happens next could be that interest rates stay high and go higher as the Iran conflict drags on and oil price stays elevated. There's also definitely a pathway where interest rates come back down again. You know, a swift resolution, all hands to the oil pumps, and ships moving quickly and freely through the Strait of Hormuz. Potentially this gets back to normal sooner rather than later. I'm not an economist and I'm not an oil analyst, so I don't know how likely that outcome is, but it's definitely there on the table. And as you can imagine, the first case scenario that I've sort of stated there is going to be pretty tough for property. Property values are based on yields, and they tend to trade somewhere above, you know, your risk-free rate, whether you're measuring that through gilts or base rate or something else. Equally, if everything goes back to normal, inflation never really gets up above 3.5% or so, and everybody just sort of breathes a sigh of relief at the end of April, property values could well stand to benefit from that. Certainly, the REIT shares will rebound quite swiftly in that scenario, if it plays out, because that yield expectation will come down, and that will play through the valuation expectations as well. It's very, very tough to say which of those outcomes will play out. As I say, I'm not the expert here, but what I find particularly interesting is that whenever I listen to other experts, and you know, people like Richard and other fixed interest and economists out there, it's hard to find consensus. There's for every analyst who says rates are going to go up, there's another analyst who says that you know, a falling GDP scenario will cause rates to have to come down again. So it's, like I say, it's really hard to pin the tail on this particular donkey. What I will say, to pick up on the sort of second part of your question, is that the areas within property that are perhaps most interesting or perhaps most resilient at this point in time are those where the starting yield is higher. So if you imagine assets that maybe a few years ago might have been quite out of favor, like shopping centers, where the starting valuation yield is somewhere in the 7.5–8% arena. Your base rate or your gilts going from 4.5 to 5 is probably quite absorbable by a sector with those sort of valuation yields. Whereas if you're operating in a tighter yield environment, in more in-demand assets, like, for example, the industrial warehouse market, they're perhaps a little bit more vulnerable to rate rises as and when they sort of come through. So there's a slight sort of surprise to that factor, where the assets that were, as I say, historically less in favor are the ones that are proving to be a little bit more resilient in this environment.
So, Oli, we sort of very much focus on the wider macroeconomic picture, but of course the property sector is broad-based and consists of numerous subsectors, each with their own characteristics. And you sort of touched briefly there on sort of supermarkets and industrials. Are there any areas of the property market that are of particular interest at the moment, or equally other parts of the market where conditions remain more challenging? I know previously that you've highlighted areas such as data centers and convenience-led assets. Was also pointing to ongoing weakness in areas like student accommodation, and we've also seen sort of ongoing pressure on house builders. So it would be great to hear your latest thoughts on some of those subsectors.
Yeah, and I'm actually really glad you asked the question, Andrew, to be honest, because as a real estate analyst, we've been slightly, as a sector, slightly focused on interest rates and macroeconomic data, which, as you can imagine, to some degree or other affects the whole property market in the same direction, if not necessarily to the same extent. But there are thematics out there that do still apply, and there are good sectors and less good sectors and downright horrible sectors as well, to be honest with you. You've stolen my thunder completely by highlighting some of the ones that I would alight on as well. But I think that shows that you've been paying attention, so I can't complain there. Data centers is probably the one area of the property market at the moment which is universally accepted as being in a real bull phase. You can imagine why. Clearly, the onset of AI as a global trend is in full effect, and the data centers are where that happens. anybody who's launching an AI product or building one out or just adopting one is driving up the need for new data centers. And they are a difficult thing to build, not only in terms of the technological requirements, but also in terms of the planning regulations and also the power requirements that come with them. So if you already own a data center, you're very much happy to do so and happy to hold it and see its values go up. The other area perhaps that might be worth thinking of in positive light is the senior living sector, where which is not a huge sector in comparison to something like data centers or the office and retail markets, but it's a sector that is also enjoying very strong supply demand imbalance in favor of the people who own the assets. As you can imagine, the UK and much of the Western world has a growing elderly population, and what it doesn't seem to have is a growing elderly care sector. So the demand for beds remains very high, and the supply of them is comparatively low. So it's another sector where that imbalance is really favouring the landlords and the operators as well. Student accommodation, you mentioned, I think that's a really tricky area right now. Slightly more balanced and slightly harder to get under the hood of, because it varies very much based on which city you're operating in. But in general, it's kind of tricky, because you might imagine the student numbers are sometimes looking pretty good depending on which database you're looking at. Number of 18-year-olds going to university is still strong. The number of international students coming across is still fairly strong. Hidden within that data is the sort of willingness to take out premium accommodation versus staying at home or moving into the sort of the HMO type of arrangement. What we're actually seeing in the market is that the willingness to do that is increasing, and the sort of downward pressure, or at least lack of upward pressure on student rents is becoming a bit more visible. So it's a tricky sector right now. And I think you're also right to highlight the house builders, which is a sector that is very much struggling. And you can imagine again why their end user is very much dependent on mortgage rates for affordability statistics. And as gilt yields and base rates go up or stop coming down, their experience is becoming much more negative. And unfortunately, the house builders are very much sort of supercharged to that outcome. So if you think of a normal property landlord as being very geared to interest rates, then the house builders are even more so. So it's a really tough market to be in right now. I think those are the sort of the key areas to think on, but I mean, I'm sure our listeners will have their own views, and if so, please do send them across.
Thank you very much indeed, Oli, and of course to Richard for those great insights, and to you all for listening. Did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show wherever you're listening and share it on your socials, and tag us at Quilter Cheviot to make sure you don't miss a future episode. Tap the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on the current conflict and other market news, industry insights, and upcoming events and webinars on our website or on our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you again to Richard and Oli for your time, and to you all for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.